Well, this virus continues to impact our lives more than any of us could ever have expected, and it just continues to be a big mystery as to what the future holds. We're going to try on the program today to answer some of your most asked questions, from the economy to the markets to the taxes to your finances. Clearly, this thing is evolving each and every day, and so the story last week or the week before is certainly very different than the story now, starting with the fact that while it is Sunday morning and we are doing this program sort of live, or it is live on Sunday morning, this is not a pre-recorded program. We are actually doing it from our house. Got the call late on Friday evening that the folks at iHeartMedia decided that they wanted, at least for this weekend, the hosts that do the radio programs to do it remotely. So this is certainly a little bit of a unique experience, just as this whole situation is for us, because we are now doing it on through the phone, calling into the program. And you'll see when you look at the video on YouTube just how different the background is. It's definitely not a radio studio. It's me sitting with a bunch of those Apple headphone sets connected to a phone, and that's how we're doing the program. So welcome to Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. You're listening to one of the top 25 financial planning podcasts on the World Wide Web, thanks to that distinction from the folks at FeedSpot. So let's just dig into it, right? The first question I want to address is sort of what is going on with our firm and how are we handling the operation. Well, we're still open, and in the banking and financial services sector generally, that sector is exempt because, or at least certainly from seeing some of the orders that are happening in other states, that sector appears to be exempt in terms of its ability to remain open. At the end of the day, people need to have access to their money. So it makes sense for someone like our firm to continue to be open and be generally exempt from whatever the orders might be. Obviously, that can change, but that's the perspective that we currently have now in terms of what might happen down the road if a quarantine order is issued for the state of Florida. A number of changes, obviously, to the extent that you are contacting the office. First, we had a client meeting scheduled for this Thursday. We're still going to have that. It's just not going to have an open bar and a dining room and a ballroom. It's going to be a conference call where you can call in and listen in to the speaker. We were going to have a speaker, and it's the same speaker, and she's agreed to kind of help put us with this conference call. And so on Thursday at 6 o'clock will be a conference call. Our clients will all receive an email from me either late tomorrow or early Tuesday with the information about that call, the number to call in, and the access code. So that's one of the things that we've certainly adjusted on our end, but certainly in light of the current economic situation, we thought it would still be important to certainly have the event and give our clients the opportunity to dial in and listen to the speaker as they normally would. Unfortunately, it's a time when we could all use an open bar, but we won't have an open bar because it will be a call. So anyway, that's probably the biggest change in terms of the week ahead for things around the office. We've also changed all of our appointments to a phone. I mean, obviously in the interest of health, we're switching all of our appointments rather than face-to-face to be able to be done on the phone. And then at the office, to the extent you're dropping something off or picking something up, we will have a box outside. And of course, we have a doorbell at the office. So just ring the doorbell when you drop something off, and then we'll be able to come out and pick it up. Or if you are picking something up or need something that needs to be signed, just give us a call ahead of time, and we will put it in the box so that you can just kind of sign it, and that will take care of that. So obviously, some adjustments in terms of how we are operating. If we do wind up having to stay home, then the good news is that we are, as a firm, fully cloud and internet based. The decision was made to move to that about a year ago, and so we certainly have the capability, whether it's with our phone number and the connections that we have. The phone is all internet based. The client management stuff is all internet based. The investment account information, ability to transact is all internet based, including the tax stuff. So all of that being internet based allows you the flexibility to be able to work wherever. Again, our clients should look for an email either late tomorrow or early Tuesday with the information on how to call in to join in on the client meeting. So that's kind of the perspective from the office and some of the changes that we've made and some of the things that our clients should look out for. We are still pushing ahead with taxes. We think that's still important, particularly to get the taxes done, because if you have a refund, then obviously you want that as soon as possible. That's one of the questions that we'll answer later in the program in terms of what the current state of tax filing deadlines and things like that are. But before we get to that, we've got a host of other questions that we want to kind of tackle during the course of this program. Besides the question of sort of what's going on with our operation, the next question that we've been getting a lot of is, why don't they just close the markets, right? I mean, why not just close the markets, temporarily shut them, and then when this passes, then reopen the markets? Well, as enticing as that may be, given the sharp swings in the market over the course of the past couple of weeks, the reality is that there is still business going on. I mean, this is as much as it feels like we've gone from an economy that is growing, and it's $15-16 trillion economy. It certainly has had the brakes slammed on it, but there is still business going on, right? I mean, you can still go to the grocery store, order stuff from Amazon or Walmart, use your cell phone, stream your movies, all of that. So there's still things that are going on, and so in order to make sure that those things continue to function on a regular basis, you certainly need to have the financial markets open, because that's the medium of exchange. If you're an individual, if you're a business owner, if you're a corporation, then you might very well need to access some of that money out of the market, and in order to meet payroll and those kinds of things. And so that's why it's so important to keep the financial markets open. The reality is that 80% of the transactions out there in the world at large are actually denominated in US dollars. So again, the importance of keeping the markets open cannot be understated, and then that's why they continue to do that. You also have to understand that from a liquidity perspective, the ability to sell, say, 100 shares of Microsoft is important so that you can have the economic system, the financial system, continue to function. The reality is that there is a lot of trading going on out there, and certainly there is more sellers than there is buyers. But remember that every transaction in the market, there are always two parties. You don't get it with just one party. There is always a seller who believes something, and there's always a buyer who sort of believes the opposite of what that seller is thinking. So when you stop and think about it, when you think about the markets and how much that movement has occurred within the markets within such a short period of time, understand that every transaction in the market has two people. And those two people, one of them thinks one thing and the other person thinks completely the opposite. So understand that there's still business to be done out there. There's still people that are navigating the markets. And so consequently, that's why the financial markets need to continue to stay open. Certainly an interesting concept, if you will, much like the economy. in large parts is sort of with these quarantine orders and these stay-at-home orders, sort of almost sheltering in place. It would certainly be sort of a novel idea for to put the same thing on the markets, but the reality is you still need those to function because people still need to be able to access those types of investments as well. And I think that's the important thing to remember, along with the fact that, again, every transaction, there's a buyer and a seller and a buyer. Seller thinks that he doesn't want that particular company anymore, and guess what? The buyer, he wants that at that particular price. So remember, that's how the markets function on a daily basis. So a couple of things, questions that we wanted to just sort of get out of the way right out of the gate. And then in the next segment, we'll start to really kind of tear into the meat of it, right? The question of what's the economic impact, the question of why should I be staying invested in the market, taxes, all of that. We'll continue to work through some of these most asked questions about the current situation. And we'll do that, but we'll slide to a break. And then when we come back from the break, we'll kind of get into the whole economic and investing questions that many investors have out there. So stay tuned through the break, and we will continue the program here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando. Welcome back to the program, ladies and gentlemen. On this segment, we're going to tackle a couple of those hard questions. We talked a little bit in the first segment about some things that we are doing differently at the office. And then, of course, the question of why don't they just close the markets? This segment, we're going to talk about some of the harder questions that are getting asked out there, like why should I stay invested through all of this? And ultimately, what's going to be the economic impact? Welcome to the program, of course. This is Dollars and Cents. A little different format in today's world. I'm still Joel Garris of Nelson Financial Planning, but I'm not sitting in the studio. We are doing this show live on Sunday morning. I am at my home and the producer is at the radio station. So got the call late Friday about the change of format and doing it remotely. And so here we go. A little bit of a different approach and certainly one though that we're, I guess, able to work through with technology the way that it is. So what's the economic impact? I mean, I think that's the big question out there. And obviously this virus and the reaction to it and the attempts to slow the spread of it will certainly have a significant economic impact. We continue to see this certainly as a headline-driven event rather than some kind of a systemic economic problem, much like, say, for example, 2008, right? A lot of the issues there have to do with some underlying issues with the structure of the economy. This is certainly a little bit different than that in that it's much more of a headline event. So our viewpoint remains that once this headline event passes, things will recover. It will certainly take some time to do that, but things will certainly recover. So that's the important thing to remember, is that markets move faster than data. Oftentimes right now, for example, markets don't really know kind of what the numbers are, what the data is on this, and so they're just kind of jumping to their own conclusions and swinging wildly from one day to the next. And as that pricing, as that uncertainty continues, then you see the markets trying to figure out how to price it. As the data emerges, here's the reality: the markets will have that new information, that sort of real information, and then adjust accordingly and ultimately reduce volatility. Here's the key concept: by the time you feel better, the markets will have already priced that in. So this notion of I'm going to be able to use my gut or my feelings to somehow navigate through all of this, that is going to be a very difficult situation. I think it's important to look at your portfolio right now. I think it's important to look at your mix. Make sure that you have predominantly large companies in it. That's a concept that we've been talking about on this program for years and years and years now, probably going all the way back to when my father-in-law, Jack Nelson, did this program 30 odd years ago. So large companies, I think, certainly have an economic impact. We're seeing that across the board. But at the end of the day, folks like Disney, Amazon, they're going to be okay. They're going to get through this. The reality is, and where my concern is on those smaller companies that are not as capitalized as some of the larger companies. And certainly the market is sort of taking that approach. If you look at large companies, they're certainly down close to 30% since the beginning of the year, but a lot of smaller companies and a lot of small company indexes are down closer to 45%. So there's definitely a gap between how the market is sort of trying to price this big uncertainty, in that when you look at the performance of larger companies over smaller companies, clearly the larger companies, and the expectation would be that they'll be able to weather this much better than a smaller company. And that's where the real concern, of course, comes in, is that you've got a lot of impact on small businesses and small companies that ultimately will be a significant impact on those. And so that's really where our concern is for those smaller companies, and how do they make it through this significant economic impact. Remember, the market prices the uncertainty, and it's going to always err on the side of negative. And ultimately, as you start to get more data on this, and ultimately the markets will adjust accordingly quite rapidly, which of course leads us to our next question, which many investors are asking us, and that is, why on earth would I stay invested through this? This is just gut wrenching. This is like a kick in the gut. And why on earth would I stay invested through all of this? And certainly that's a fair question to ask. It's certainly very frustrating out there. And as we reminded our clients this past week, this is where investing is hard. It's very simple to be an investor. It's very simple to have that perspective of, oh, all I have to do is be invested and stay consistent, and it sounds so simple. And the reality is, right now is certainly where it gets hard, and that's why many folks don't succeed at it, because what people forget is that money is a highly emotional tool, and because of that high emotion level, we often get so fixated and ultimately make some mistakes, because the speed of the market is such that it can react much faster, and consequently those are the kinds of things that we need to keep in mind. Here's some data to sort of back up why it's so important to be consistent. Number one, we often forget that the best days are clustered around the worst days. If you look at 2008, what many people don't realize is that even though that was a terrible year for the markets, 7 of the best performing days out of the top 20. So if you look at the top 20 best performing days since 1945, that's over the course of the past 75 years, 7 of those top 20 best performing days in the market actually occurred during the course of 2008. That probably surprises you. It surprised me when I heard that statistic, but it certainly backs up this notion that volatility has two sides, both negative and positive. When you look at that statistic of just for 2008, where you had 7 of the 20 best performing days in the market over the past 75 years, that's a big underlying reason why you want to remain consistent in your investments. Here's the other impact that has. So if you look at the returns in the market over the course of the past 20 years, annualized return is right at about 7.2% as measured by the S&P 500. So you've got 20 years. 20 years, that's 250 trading days a year times 20, so you got 5,000 trading days. All you have to do is miss the best 10 trading days. And we're not talking about 10 trading days per year. We're talking about 10 trading days out of the entire 5,000, and your annualized return, instead of that 7.2%, drops all the way down to 3.8%. That's a pretty significant difference. And if you think you're going to be able to zig and zag around this, you're just not going to. And all it takes is to miss one or two of these recovery days, and that ultimately winds up really undermining your long-term performance. Just remember that statistic, 7.2 down to 3.8, just missing 10 days out of 5,000. That's pretty dramatic. I don't know how you're going to manage to get around that. And certainly history says good days are clustered around bad days, particularly when you got 7 of the best trading days, or the top 20 trading days, occurred during the course of 2008. The reality is, by the time you feel better, you're going to ultimately, the markets will ultimately be ahead of you on that, because they move that much quicker. People emotionally don't recover or feel better until they actually see it. Well, how are you actually going to see it? You're going to see it when the market's higher, and then by then it will be too late. You get the psychology of how you can, get trapped into that cycle of expectations versus reality, and before you realize or come to the conclusion that, hey, everything's better, the market will certainly be very much in front of you. So we encourage you to look at your portfolio. Certainly now, the reality is that be careful about making a rash decision on it. Certainly call your advisor, have a conversation with them. You should certainly have been hearing from them all along the way during the course of this crisis. And so consequently, those are the things that you can be doing now. I do have sympathy for the folks that are having to call into call centers right now. Those are obviously overwhelmed. There's long hold times, there's long wait times. So my sympathy is with them. And often the advice that you get on call centers is intended to move the call along. And the reality is that it's a much shorter call to say to somebody, hey, you don't want to run the risk of losing any more. Great, let's put you to cash. That's a much shorter conversation than trying to encourage people to stay invested, to give them these types of statistics that we're giving you on the program this morning as a way to encourage you, hey, you're not going to be able to time this thing. You're not going to be able to get in, get out. The reality is this thing is moving way too quickly to come to any conclusion one way or the other. But certainly if you're calling into a call center, it's easy to move you along by just simply moving you over to cash. So be careful of that. If you use a call center, that's fine. But just understand that the motivation there is to move you along as quickly as possible. The reality is going to cash is a much, much shorter and easier conversation for the individual to have than walking you through, hey, here's what's happened in history, here's the things that we've seen before, and at the end of the day, this too shall pass. So some important distinctions there in terms of sort of what's the economic impact and why you should continue to stay invested even during this tough period of time. So we're going to slide to the break. We come back from the break, we're going to start talking about some of the nuts and bolts about taxes, about finances, about potential government stimulus, all of that on the program. So stay tuned. We'll slide to a break. You're listening to Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. We're back, ladies and gentlemen, Dollars and Cents. This is Joel Garris of Nelson Financial Planning, coming to you live-ish, not really in the studio, doing the show from home in light of today's world where folks are trying to social distance and all those kinds of things. So we're doing it here from the house. The producer is in the studio, and so we are coming to you live-ish, I guess. Well, we're still live, right? So anyway, on the program today, we've attempted to sort of tackle some of those questions that folks are asking in today's world about the economy, about finances, about staying invested, all of those kinds of things. This segment of the program, we're going to shift gears and kind of go through some of those other questions that have popped up. And probably one of the biggest ones is, well, what about my taxes? I'm told now that I don't have to bother to file them until July the 15th. I don't have to pay until July 15th. I also don't have to send in my quarterly statement, my quarterly tax payments for the year 2020. I don't have to send my one in that would typically be due on April. I don't have to send that in to July. So why don't I just kind of hold off and not bother to do anything with my taxes until July? And I would say that that is a mistake, because the reality is that the average refund in America is around $3,000. Seems to me that you would want that refund as soon as possible, particularly when things are in tougher financial shape like they are now. And so applying and getting your taxes done, getting them filed, and getting that refund, that part has not been delayed. So make sure you continue to move forward on your taxes, and you can still get them done so that you can find out, okay, how much of a refund am I getting? Or if you owe, then at least you know the number of what you need to deal for and what you need to plan. And so from that perspective, it's important to get it done so you know how much you have to plan for and budget in the months ahead. I do think it's a good idea that they extended the payments, extended the tax deadline. Certainly gives people the flexibility to pay it later, but the reality is that you've got to get your taxes done in order to know which side of the equation you're on. So we would certainly encourage you to continue to get your taxes done. There's no delay on refunds, and you can certainly still file your taxes and simply say, okay, IRS, when you come to take the money, then you take it on July the 15th, assuming that you're doing it through a bank account system where the IRS is automatically pulling that from your checking account. Or if you send in a check with a voucher, again, just have that in the mail by July 15th. But you can still get your taxes filed, and we would encourage you to do that so that you know kind of what those numbers are. There's no delay on refunds, and you can still file your taxes and tell the IRS to deduct that money in July. So some important things to continue to move forward on that. Don't use it as an excuse to, I'm not going to worry about it. Look, the reality is if you're sitting at home with nothing else to do, you might as well get your taxes done. So make sure you continue to move forward on that. What else should I be doing? Here we are, a lot of folks are finding that they are quarantined or at home and not able to go into their jobs like they used to. We'll give you some ideas in terms of some things that you could be doing. And I think certainly it's important, first of all and foremost of all, to sort of look at your income that you are currently getting. If you're retired and getting income from your portfolio, I think it's a very good time to kind of take a look at your income and your expenses, because if you're not doing as much outside in the outside world during this period of time, and that's certainly the case because there's much less options to do in the outside world, then perhaps think about reducing down how much income you are taking from your portfolio. That sort of makes sense, right? I mean, if you were still working and your job was in danger, you would certainly hold on to more cash and hold on to that. So consequently, the same thing would apply if you're retired and taking income out of your investments. We would encourage you to look at potentially reducing that down for a period of time. Chances are, when you look at your finances, when you look at your expenses, probably not spending as much as you used to, at least particularly over the course of the next few weeks here, because there's just less options to go and do things. So that means that your expenses have probably gone down. We would encourage you to do that, look at that, and use that as an opportunity to adjust your income, thereby leaving more in your investment account and ultimately leaving that with a greater potential for recovery because you're taking less out now when things are low. So number one, I would look at my income, particularly if I'm retired and drawing income off of portfolio, and look at ways to perhaps reduce that down. Number two, if you've got a mortgage, hey, great time to kind of double check whether it makes sense to refinance. Certainly with all that's been going on with the reaction to the virus, interest rates have continued to get lower. And so may be a time to kind of take a look at and at least call your current lending institution and say, hey, what's the deal? What might refinance on this looks like? You need to be careful though. Always look at not just getting too fixated on the difference in interest rate, but look at the cost and look at how much you're going to be saving. And really, ultimately, the general rule of thumb there is that you should save enough to recover those costs within a 2 or 3 year period of time. If it's longer than that, then it's probably not worth it, but certainly something to look at in terms of refinancing your mortgage. Another thing to be thinking about is if we're looking at potentially doing some type of a conversion, an IRA conversion to a Roth, maybe taking advantage of the lower income tax rates. If you're in lower income tax rates and you see that your kids, your beneficiaries, are in higher income tax rates, particularly now that the stretch IRA has been eliminated and you've got to now take that money out over a 10-year period of time, maybe an opportunity for you to look at and say, okay, well, if they're in a higher tax rate and they've got to take it out over a 10-year period of time, then maybe it might be a good time to do some type of a conversion, because then the conversion is happening when the value is low, when the share prices are low. And then as the market recovery happens, then ultimately there would be a higher amount in that Roth. So something to consider there. And then lastly, taking a look at your portfolio and seeing if on the non-IRA side of things, so the non-retirement accounts, whether there is some capital losses in there that you might be able to take advantage. Now remember, last year was pretty strong for the market, and it's been a strong period of time for the markets in general over the past decade. So there may not be that opportunity, but certainly something to look at, particularly on the non-IRA side of things, and see whether there is any opportunity for some type of a harvesting of capital loss. You do that by simply exchanging the funds around. You don't go to cash though. Again, going why you stay invested. You look for similar funds to move into in order to capitalize and convert that paper loss to a tax loss. So concept of harvesting some tax losses also makes sense. So those are some of the things that you can be thinking about in terms of looking at your portfolio and some of the things that you can be doing now to sort of in light of the current environment. So anyway, we'll continue the program. When we get back, we will continue with answering some of the most recently asked questions that sort of every investor probably has on their mind. And so we'll talk about perhaps the check that's coming in the mail, who knows, but potentially we might see that as well. So stay tuned. We'll be back after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents on News Radio WFLA. On the program today, we're tackling some of the most frequently asked questions in the midst of the coronavirus epidemic. And so we've tackled a lot of them. Obviously, we are putting the program up on all the various social media channels, including YouTube, where you get to see how we're doing this without actually being in the studio. So technology is an amazing thing, and so we're able to sit at our house and go through the producer at the studio, and then that way do the program live in person at the current time frame, which I guess now it's like 9:51. So anyway, we are talking a lot about many of those questions, so we encourage you to look at our YouTube channel, Nelson Financial Planning, in order to view the video. We'll also, of course, take the audio format of the program and put it up on our many podcast channels as well. If you're interested in learning how you can connect to those channels directly, whether they be on iTunes, Real Radio, or iHeartMedia, or Google Podcasts, or Facebook, or whatever the case may be, simply go to our website, nelsonfinancialplanning.com, and in the upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected on over. So show we'll have up as quickly as possible, usually late Monday, early Tuesday. So if you're interested in kind of catching some other parts of the program, or maybe you missed a segment, then you can certainly look at the program in that format. So next question. Getting a lot of conversation out of the folks in Washington about some stimulus that would go directly to the American consumer. As of this morning, the folks in Congress are still debating that. It looks like it may be, at this point, a combination of a direct check, and certainly we've seen that before, where they mail every person a check in the mail, or it may also be a combination of a bigger unemployment benefits as well. So I think it seems like, at least at this point, where it's going to be sort of a combination of those two, of a direct check, much like we saw in, I think it was 2010, 2009, 2010, in response to the last financial crisis, a check that was mailed out to everybody. It looks like this one is going to be $1,000 or $1,200, and it's going to take a look at your income. So if your income is below certain thresholds, then you get the check. If it's above it, you're not going to get the check. So the thresholds are around 100,000, 150,000. There's a bunch of numbers that are getting thrown around right now. Now, obviously, this is legislation that's still pending. On next week's program, we'll certainly have an update as to exactly what those numbers are, assuming that they pass it during the course of this week. But expect that, along with some difference in terms of the unemployment benefits as well. So a bunch of things still outstanding out there, particularly on the business side of things, in terms of the loans that may be available for businesses. So again, stay tuned on that. We'll continue to use this program as a format to keep you informed, but nothing definitive yet. The only thing that is definitive is the pushing out of the tax filing deadline until July 15th. That includes not just filing your taxes, but also, more importantly, paying them along with the first quarterly payment that you would have to make typically by April 15th for the year 2020. Again, all of that's pushed by July 15th. I want to take another moment to actively encourage people to get their taxes done, though, sooner rather than later. The delay has nothing to do with a refund. You can still file your taxes and get a refund. And if the average refund is about $3,000, it would seem to me that that's important to get that money now. So you want to continue to do your taxes. Try and get as close to the April 15th deadline as you can so that you can plan accordingly. If you're getting a refund, you definitely want to file them and get that money. If you owe, at least you file the taxes, you know what you owe, and just send the payment in July. But that gives you some time to sort of work to get that money together. So lastly, and here's a tricky topic, and we thought we would save it sort of to the last couple of minutes of the program. You know, how do you feel about this, Joel? I mean, at the end of the day, we've certainly seen a lot, right? I mean, we were in this business back in the dot-com era when that bubble burst. We went through a tied presidential election of Bush versus Gore. Nobody ever really likes not knowing who the leader of the free world is after a completed election. Certainly the markets had a pretty negative reaction there. Then 9/11, obviously the devastation there and the shock and the emotion. And then through the financial crisis of 2008. And so certainly there's been a slew of events during the course of the past 20 plus years of doing this that we've seen. The good news is that on every single one of them, this country has persevered, and this country has gone on to achieve higher highs, and the market has also gone on to achieve higher highs in every single instance. So make no mistake about it, that will happen again this time. That's the power of the economy, that's the power of America, and I believe that that will happen just as it has happened through all of those other events through history. The question that concerns me right now is whether the cure may be worse than the disease. And I'm not the only one to raise this. The folks at the Wall Street Journal in their op-ed piece on Friday raised this very question. Is the cure worse than the disease? The economic hit that this country is taking, particularly among small businesses, is significant. Make no mistake about it. And that's where the burden is being felt. Look, we're not China, okay? And at the end of the day, China, as a government-controlled economy, is absorbing the hit. But here in the US, it's going to be absorbed much more by individuals and businesses. And that's where my concern lies, is that it also is taking a toll on everybody's mental and emotional well-being. and through higher blood pressure, ulcers, and Lord knows what else. And that ultimately has a health impact as well that I don't think is getting considered in the grand scheme of things. I don't know that I have all the answers or all the numbers or any of that, and clearly human life is invaluable, but at the end of the day, we all make those kinds of calculations involving our basic human activities, that there's no way that we can make this some kind of a zero risk proposition. My concern is that some of the response is trying to get to that. And the reality is, whether it's us driving, whether it's us smoking, whether it's us drinking, they're all things that we do as human beings that we ultimately calculate and assume the risk on a daily basis. And so the issue and concern that I have here is, what's the ancillary impact that you're having on the economy as a whole and on the debt that you're generating for future generations? And I think obviously much remains unknown, and it's a story that's evolving and changing each and every day, let alone each and every week. But I certainly have some concerns that we've been expressing along the way as to whether, in fact, the cure may be worse than the disease. Time will tell on that. We'll see how those numbers play out. In the meantime, we got to get out of here and wrap it up. We'll be back next week with updates on what's going on. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents, News Radio WFLA Orlando.